You think the next crisis is going to be a repeat of 1929, another stock market collapse? You're wrong. The ghost of 1929 was financial. The collapse coming for you is a government bankruptcy, and the math is the weapon. There's one number economists don't want you to see. $36 trillion. That's the U.S. debt, and today the cost of servicing that debt is the biggest geopolitical threat in history. I'm going to show you the math that proves the dollar as we know it is dead, and why the U.S.'s only way out is to break its promises. The real lesson of 1929 was never about stocks, it was about denial. It was about an entire nation deciding that the prosperity they felt in their fingertips could not, under any circumstances, be fake. They ignored the surging debt, the ridiculous margin trading, and the inequality that was crushing the middle class. They thought they had discovered a new financial paradigm that was immune to the laws of economic gravity. Nearly a century later, we're repeating the exact same naive belief, but we're applying it to the government's money itself. In 1929, the collapse was financial, a failure of Wall Street. Today, the failure is in the heart of Washington, D.C., and it is a mathematical failure that cannot be solved. It's the collapse of money, and it has an exact price tag, $36 trillion. That is the weight of the American national debt, and it's not just a large number for alarmists to wave around. It is the death sentence, the undeniable proof that the dollar as the global reserve currency is in its final moments. The question is not if the dollar will fail, the question is how, and what you will do when the world's largest debt finally comes due. To understand the urgency, we need to talk about interest. For years, the U.S.'s trillion-dollar debt was just a theoretical problem, something the next generation would deal with. But interest rates are not zero anymore. With the Federal Reserve forced to raise rates to try and contain inflation, the cost of refinancing all that debt has absolutely exploded. The U.S. government is now paying a shocking $1 trillion per year in interest alone. $1 trillion. To put that in perspective, $1 trillion is more than the U.S. spends on national defense. It's more than the combined budget for Medicare and most social programs. The largest single discretionary budget item in the country is now going not to the defense of its borders, not to infrastructure, and not to the care of its elderly. It's going to service a debt that will never be paid off. This is the definition of insolvency, and that single fact changes the global balance of power. The ghost of 1929 and the denial of credit. In 1929, the denial took a specific form, the credit bubble. People could buy stocks with up to 90% margin. That meant you put down $10 and borrowed $90. It was a bet that growth would never end. The crash was not caused by the stock market itself, but by the panic that ensued when the margin call required everyone to pay back the $90 they didn't have, which froze the banking system. Today, the credit bubble is not in stocks, but in the government. Instead of a 90% margin on stocks, the U.S. government is operating at 130% debt to GDP, a level only seen during world wars. The denial is the same, the belief that the debt will never carry a cost. But the cost arrived in the form of $1 trillion in interest. The difference is that in 1929, you could sell your shares. Today, who will buy the government's debt when the math shows the only possible payment is devaluation? The government has become the insolvent debtor, the ultimate source of instability. When the cost of debt becomes a country's single largest expense, that is where politics meets bankruptcy. The math is simple. If a country cannot generate enough revenue to cover its interest payments, it has only three exits. 1. Drastically raise taxes, which kills the economy. 2. Severely cut social and military spending, which leads to social unrest and a loss of geopolitical power. 3. Print more money. Guess which path Washington always chooses? The third option, printing. It's the quiet option, the one that requires no unpopular spending cuts and no tax hikes on the donor class. But printing money does not pay off debt, it monetizes it, which simply dilutes the value of your existing money. It's an invisible tax on everyone who holds a dollar. It is the slow death of purchasing power, guaranteed devaluation. The hyperbolic acceleration of debt. How frightening is the speed at which everything is moving now? In 1929, news moved slowly, in newspapers and over the radio. Panic took weeks to spread. Today, the U.S. debt is rising at an almost unbelievable pace. More than $1 trillion is being added to every 100 days. Every 100 days, the American government digs itself another $1 trillion deeper into the hole. This isn't a cycle, it's an out-of-control hyperbolic spiral. This spiral negates any argument that we can grow our way out of the debt. Debt growth has consistently outpaced GDP growth for well over a decade. If debt grows faster than your income, you are insolvent, period. And worse, if you think 1929 was about speculation, look at today's assets. The stock market is priced for perfection, housing is inaccessible to a generation, and technology valuations completely ignore the rising costs of capital. The echoes of 1929 aren't in the stock tickers, they're in the collective denial that real money has a price. The end of the exorbitant privilege, the geopolitical of trust. Let's detail the anatomy of system failure. The US dollar has been the global reserve currency for one reason: trust. That trust is what allows the US to print the world's primary trading currency, run absurd deficits, and maintain low interest rates. It's what the former French president Valéry Giscard d'Estaing called the exorbitant privilege. But that privilege is now under fire. Historically, it rested on two pillars. 1. Military security, the guarantee that the U.S. would protect sea lanes and the global economy. 2. Petrodollar, 1970s, the agreement with Saudi Arabia forcing the world to trade oil only in dollars, guaranteeing global demand for the currency regardless of America's internal debt. Both pillars are crumbling. The main threat is not military but irresponsible math. Major creditors, nations like China and Japan, are drastically reducing their holdings of U.S. treasuries. China is at its lowest level of bond ownership in 14 years, and they are buying gold massively as an alternative. They're shedding the risk because they see the same math. Either the U.S. government cuts spending, and thus its geopolitical power, or it prints, devaluing the actual worth of their bonds. This is a dead end.
BRICS and the silent checkmate. The geopolitical response to this insolvency is moving through the BRICS: Brazil, Russia, India, China, South Africa, which is now expanded. BRICS is not just a club of emerging nations, it is a club of nations actively seeking a dollar alternative for commodity trade, especially energy trade. Russia, after being sanctioned in 2022, proved the point. The dollar can be used as a weapon, and any nation opposing Washington risks having its reserves frozen. This removed trust. China is actively negotiating oil with Saudi Arabia in yuan, circumventing the petrodollar. This is the silent checkmate that BRICS is executing. If the U.S. can no longer use the dollar to pay for global goods and oil, global demand for its currency plummets. This is a double blow. The $36 trillion debt becomes a strictly domestic problem, and the cost of living in the U.S. skyrockets as the dollar loses value internationally. This turns the 1929 collapse, the great lesson of denial about stock prices, into 2029, the great lesson of denial about the price of money itself. The denial in 1929 was the belief that the speculation bubble would last forever. The denial today is the belief that the American economy is large enough to absorb the $36 trillion debt and the $1 trillion interest cost. The problem is no longer the bubble. The problem is the foundation, and the foundation is rotten. You may have heard the mantra that war debts are different, or GDP is bigger than in 1929. These are dangerous distractions. What really matters is the effective interest rate. In 2024, the cost of servicing this debt has become a ravenous monster, forcing the Fed into an impossible position: fight inflation and not bankrupt the government at the same time. Historically, when interest payments hit this level, something big and bad happens. It usually results in financial repression. The mechanism of financial repression. Financial repression is the elegant term for the slow death of your purchasing power. It's when the government uses regulatory power to keep interest rates below the inflation rate. For example, if real inflation is 10%, but the Fed artificially keeps savings rates at 2%, the real interest rate you receive is negative 8%. This ensures that the real value of the debt slowly disappears through your loss of purchasing power. It is death by 1,000 cuts to your paycheck, an invisible tax that no one voted for, but everyone pays. The inflation we feel today is not just a supply and demand problem. It is the first sign of the money printing machine trying to solve the $36 trillion problem. Let's go back to 1929 for a moment. The people who suffered most were those who had money in the bank, but lost their jobs and their trust in the system. The money itself didn't evaporate. The trust did. And when trust goes, liquidity freezes. Today, our crisis of trust is not about the banking system being too big to fail. It is about the government itself being too big to save without destroying the currency. The government has become the bubble. And when that bubble bursts, it won't be a stock market crash. It will be a sovereign solvency crisis that hits everyone. What survives financial repression? The final lesson. To protect yourself from the true echo of 1929, which is sovereign bankruptcy, the lesson is simple but brutal. You cannot safely hold your wealth in assets that the government can print or devalue to solve its own problems. The difference between the Great Depression and what is coming is that in 1929, money was still formally linked to the gold standard. Today, money is purely a government promise, and a $36 trillion promise is mathematically unsustainable. So, what survives? What does the 1% who get rich in every collapse do? They move to liquidity and assets that are not paper promises. 1. Precious metals, gold and silver, physical metal. It is the only money history proves lasts. It cannot be printed and is not a government liability. While the dollar devalues, gold maintains its purchasing power. It is the ultimate insurance policy against the printing press. 2. Productive and scarce assets. Think high-quality farmland, businesses with strong cash flows in essential goods, or stocks in companies with very low debt ratios and real pricing power. These are value generators, not speculative bets. They produce wealth and income regardless of Fed policy. 3. Rare skills and strategic liquidity. Skills that are difficult to replace, like a specialized plumber, AI engineer, or elite doctor, are valuable in any economy. Additionally, holding a cash reserve in currencies or assets that are not directly tied to the US dollar, like the Swiss franc or Chinese yuan in ETFs, or even digital hard assets. Liquidity allows you to buy assets at liquidation prices when panic inevitably hits the housing and stock markets. This is the time to be agile. The US has two options. A. The Great Sacrifice. Strong dollar, cut $1 trillion in annual spending, which means gutting the U.S. global military, dismantling social programs, and accepting domestic unrest. This strengthens the dollar, but destroys the empire and the social fabric. Or B, the Great Print, weak dollar. Print or devalue the debt away to make the $36 trillion look smaller, solving the interest crisis, but devaluing the wealth of everyone who uses the currency. Historically, empires always choose option B. The tragedy is that option B is the only one that guarantees the loss of your purchasing power, and BRICS is standing ready to be the lifeboat when the main ship goes down. The denial of 1929 was corrected by years of suffering and by government intervention. The mistake today is that the government is the problem, and the correction will not come from intervention. It will come from mathematical inevitability and the rise of a geopolitical alternative. The question is not if you will see a Great Depression, it's whether you will see what the modern Great Depression truly means: the end of irresponsible money. If you want to understand how to prepare for these financial questions, subscribe so you don't miss the next videos, and tell me in the comments, what's your view on the collapse of the dollar? Don't forget to like and follow the channel.